Thank you, Madam Vice Chairman. Chairman Powell, thank you for being here today very much. I had some questions also on labor market participation, and I think you've addressed those, and also on immigration, how that could help us increase our labor pool. But I was thinking about the status of across the country now. We've got over 30 states that put in minimum wage laws from $13 to $16, and there's something business is affected with everywhere. How do you see that's going to address the situation on the mismatch between labor scarcity and yet this very low wage growth that we see, and how's that tie into inflation?
Well, we don't take a position on minimum wage. It's really an issue you have to balance. There are two things to balance, and if I were you, I'd look at a broad range of research. Research comes to different perspectives, but in essentially all the research you see, when the minimum wage is raised a significant amount, you'll see some job loss and you'll see some wage gains. And I would look at a range of that research, and I would try to think what the right policy is. That's how I would do it. In terms of inflation, it doesn't really play much into it. First of all, our mandate is price inflation, not wage inflation. We don't see wages moving up in any kind of way that suggests that they would put unwelcome upward pressure on prices. So I don't really think it is an important part of the inflation discussion right now.
And trying to translate this labor scarcity that we have into higher wages for the American workers. From 2012 to 2016, we had about a $120 increase per month in average wages. And then in 2016 to current, that's been cut in half, about $56 a month. And yet, this is in the time of the lowest inflation, as you said, in 50 years, these last 18 months. So what does that mismatch between wage growth and lower unemployment mean to our economy?
Well, so we look at a wide range of wage and compensation measures, and what they tend to show is if you go back 5 years, wages and compensation were going up about 2%. That has gradually moved up to about 3%. And so that's really the trend has been upward. And that's consistent with the thought that a tighter labor market, lower unemployment, and surveys that suggest the labor market is tight. It is consistent with that. But we've seen wages moving up. We look at I could tell you the principal ones we look at, but I think that's true across all major measures of wages over the last, let's say, 5-6 years.
But why do you think they've slowed so dramatically the last 2 years?
You know, I think it's hard to say. I think average hourly earnings is an important one, which peaked at 3.4%. Earlier this year or at the end of last year, and has been sort of trickling down. It's right at 3% now, so it's a fairly modest one. I'm not at all sure why that is. It may be compositional effects. Some argue that as older workers retire, younger workers come in and they have lower. But in any case, you know, it's consistent with this idea that we're not seeing excessive tightness in the labor market that's generating outsized wage gains. We're seeing kind of nice wage gains given inflation and productivity, but nothing that's at all out of line with that.
Thank you.
Chairman Powell, we're borrowing as a country, as a government more than ever, with debt held by the public expected to reach 95% of gross domestic product within the next 10 years. And yet we're also paying interest on that debt at an all-time historic low with a 30-year borrowing cost of just 2.4%. What's the reason for this, I guess some would say, fortunate fiscal reprieve at a time when Congress as an institution has shown really no sign of fiscal discipline at all? So what does it come from? Well,
it really is a long-term trend. For example, if you were to look at a graph of what the 10-year Treasury yielded, if you went back 40 years, what you would see is a ski slope down, and it's all the way down to today. This is a long-term trend. By the way, it's true all around the globe. Now, why is that happening? I think it's, first of all, it's inflation getting under control, becoming less volatile, and ultimately continuing to decline to the point where the risk of lower inflation is actually greater than the risk of higher inflation at the moment. That's part of it. It's also just aging demographics. So as people get into their later years, they save more. That creates more savings and per dollar of investment, and that tends to drive interest rates down. And I don't know that trend shows no signs of reversing or anything like that. So that's really what's going on with these longer rates.
Some have suggested that because we in the United States, that the United States government borrows in its own currency, this level of spending isn't a problem because the Fed can just monetize the debt and keep doing so more or less indefinitely. Well, what's your reaction to that talk? Are there risks inherent in it?
Yes, no, as I mentioned in my testimony, the fact that interest rates are lower does mean that we will pay less in interest. It does not mean that we can ignore deficits at all. We're going to have to get on a sustainable path. What does that mean? So the debt is growing faster than the economy. It's as simple as that in nominal terms. And that is, by definition, unsustainable. Ultimately, you will have to get it to where the debt is not growing faster than the economy. And it's growing faster in the United States by a pretty significant margin. So even with lower rates and even with decent growth, there's still going to be a need to reduce these deficits. And I would say, by the way, that's a need over time. You know, we're not in the business of advising you when to do that or how to do it, but it is inevitable that over time we will have to do it. And you know, frankly, if we don't do it, what happens is our children will wind up spending their tax dollars more on interest than the things they really need, like education, security, health.
In the past, you've mentioned uncertainties in the area of international trade as imposing something of an economic headwind for us. What, after we've had, over the last couple of years, a lot of trade measures going into effect, what has the Fed learned about the interaction between trade and monetary policy?
So the first thing I need to say is we should never be heard to be commenting on trade policy. It's not our job. We try to stay in our lane, but our lane is the economy. But we don't have any view at all, and we wouldn't express one on trade policy itself. Our lane is the economy. So in principle, anything that affects our ability to achieve our mandated goals is an appropriate subject for monetary policy. So we've been hearing now for a year and a half from companies, and I think this is fairly widely accepted now, that tariffs, but to an even greater extent, uncertainty around future trade policy is, for now, it has been weighing on business sentiment and is probably part of the global slowdown in manufacturing, in business investment, in exports, in trade. Part of the story. There's a much bigger story out there, but it's a part of that.
I see my time's expired. Senator Klobuchar.
Thank you very much, Mr. Chairman. Thank you to you, Mr. Chairman, for being here today. Some of the issues that I was going to raise have been discussed, the challenges ahead with our economy, including the deficit, which I will note was greatly exacerbated by the last tax bill, and as well as problems in some sectors, such as agriculture, which is very important to us in the Midwest. But I wanted to focus on a third issue I have, which is income inequality. And even if people have jobs, it's often hard for them to afford things. And then you have the added problems and strains. Washington Post reported this year in September that income inequality in America is the highest it's been since the Census Bureau started tracking it more than 5 decades ago. The top 1% have experienced income growth of over 200% in the last decades. And between 2007 and 2016, the median wealth of lower income families fell by 42%. In your opinion, will widening inequality lead to lower growth expectations over the long term? And what should we be doing about this?
So I guess I would start by saying that I think we probably would all agree that prosperity should be as widely shared as possible. And so I would just point to 2 aspects of the broader problem that I think are important and need attention. The first is just the relative stagnation of incomes below the fairly high part of the distribution. And that's even after allowing for taxes and benefits and things like that. That's one thing where we want to see incomes moving up broadly across the income spectrum. The second is mobility. I think you want to see people moving from the bottom to the top, and vice versa, by the way. It has to happen just as a matter of arithmetic. So, for example, the bottom 20%, what are the chances that if you're born in the bottom 20% of income or wealth, you'll make it to the middle 20% or the top 20%? The United States actually lags most other wealthy countries in that measure now. This is very much not our self-image as a country, and those are things we need to address. So I think those are important.
That's one. And I think increasing the minimum wage, I have my own views on this, would be helpful. But as you talk about that, one of our challenges right now is hooking up our education system with the jobs that are available right now and making sure everyone has access to those jobs. And I don't think it always means a 4-year degree. Some of the fastest growing job areas are 1- and 2-year degrees. I think we're going to have 64,000 or 74,000 openings for electricians. And one of the things I'm really focused on is apprenticeships and trying to make it easier for people to access those kinds of degrees. Could you briefly talk about that?
We just met last week with 6 people who run apprenticeship programs and funding of apprenticeship programs around the country in our boardroom, and I have to tell you, it's very, very impressive what they can do. They're focusing on low and moderate income communities. They're getting them in high schools and out of high schools and matching them up with employers who need those people. They're getting good jobs. It's really working. And the thing that limits their ability to do this on a much wider scale is funding. So,
Exactly.
yeah, it's very impressive what they can
I
do.
think a lot of this is how we use our resources for education and matching that up. I'll ask you in writing a question on retirement. I just think it's becoming such a challenge in our new economy and Senator Coons and I have a bill to address that called Up Savings Accounts, which I think is a great idea for small and medium businesses. But my last thing is back to the income equality very briefly. How would reporting economic statistics by income bracket benefit our understanding of the economy? We don't have that right now.
We're actually doing something with that at the Fed. You know, we like to cut data up and look at it in new ways, and this is one of the things we're doing is combining a couple of data sets that we had. We're quarterly publishing a distributional financial account.
And when will we get that then, by the next?
The next one comes out every quarter. So it's a new thing that we're doing. And again, it's just a combination of 2 existing data sets that we have. But we think it's an interesting insight into the economy. There are a lot of different ways to look at what's happening in the economy, and that's an important one.
Thank you.
Representative Herrera Butler.
Thank you. I apologize if some of this ground has already been covered, but it's a pleasure to be here and to have you. This is the number one, I would say the growth and the forecast of our economy is probably the number one thing that impacts the people I serve in Southwest Washington. And so it's helpful to hear from your perspective. Specifically, in rural communities where unemployment is higher than the national average, most of my areas are rural, although we're bumping up everywhere. I wanted to hear some of your biggest takeaways, and I've gone through some of your testimony. Again, I apologize if you're repeating. But in terms of outlook and some of the things that we've done in the most recent years with regard to the Tax Cuts and Jobs Act, different regulatory changes, but to either maintain the growth that we've seen or expand it, what recommendations would you give?
Well, first, I think the outlook is still a positive one. There's no reason this expansion can't continue, and there's a lot of value in continuing it, and we're trying to use our tools to accomplish that. We're seeing this the 11th year of an expansion, now the longest in U.S. recorded history. What we're seeing is that income gains are the highest at the lower end of the wage scale, and so it's very positive. We're also seeing people being pulled back into the labor market. There's a lot to like about this rare place of the 11th year of an expansion, and I think we're certainly committed to doing what we can to extend it.
In that vein, I know your testimony touched on concerns with regard to the national debt. Could you elaborate on that and how it should be addressed, particularly as it relates to expanding or at least not contracting the economy?
So I think it's a longer-term issue that I imagine we all realize will have to be addressed over time. It's just the case that now that the debt is growing faster than the economy, than the nominal GDP. And ultimately, in the long run, that's not a sustainable place to be. Now, how to fix that? It's easy to say that, and how you do that and when you do that is an issue that is up to you and not to us. But I would be remiss in not pointing out that the consequences of not addressing it are just that we'll be spending more and more, our kids really, and grandkids, they'll be spending their tax dollars servicing debt rather than on the things they really need, as I mentioned earlier, education, healthcare, security, all the things that we need, that they'll need, they'll be spending more and more of their money on tax. But you don't need to balance the budget or pay down the debt or anything like that. You just need to get the economy growing faster than the debt. And that should be I think, the goal. And by the way, the successful programs for countries to get back on a sustainable path tend to take place over a long period of time and be relatively gradual. And I would be looking at something that would work over time, but really would not be giving you a lot of advice on how to do it.
Hey investors, Zach Guzman here. Are you interested in learning more about the markets and getting the latest financial news? Well, then click right here to subscribe to our Yahoo Finance YouTube channel. Get the latest up-to-the-minute market analysis, big interviews in the world of finance, and information on how to manage your money every day wherever you are.